good evening and welcome to this study circle meeting on common pitfalls in financial reporting and application of accounting standards. We have CA Priyanjali today to address us and share her experience on this. I request our chairman Pramod Aregre to escort her to the dais and greet her with the floor. Okay. Welcome to you, Priyanjali. Request chairman to give welcome address.
Good evening, members. Welcome to the most pivotal topic which we use regularly in our office, and of course now September is not far due, so I think most of the audits have started. So I firstly thank Ms. Priyanjali for accepting this invitation on this topic of common pitfalls in the financial reporting and application of accounting standards. Today I think the session will be more towards practical application of these standards. We all are aware of accounting. We have two gaps currently now. One is normal accounting standards, second is Ind AS. So when you're preparing financial statement, probably you will come across quite a lot of intricacies and implications on the Schedule 3 impact as well. So it is very evident that we refresh our memory and realign with the standards. Most of the time we would have thought this is what I know and this is what we are applying for, and probably we might miss out certain disclosure standards or even the application standards. So that's why I feel this is very crucial. So let's have a deep dive in on what is that which we look into or we miss out mostly doing. And also I request Ms. Priyanjali to also look into the impact of normal accounting standards also in the Q&A session, so that they have the clarity and most of them are not confused while preparing their financial statement or during the audit of their financial statement. With this brief introduction, I welcome all of you, and before we start the session, I request our secretary to give a brief introduction. Thank you.
Thank you, Chairman. A brief introduction of Priyanjali Agarwal. She is a director with Grant Thornton's Financial Reporting Advisory Services practice in India. She has more than 12 years experience with Grant Thornton, and she is a member of Institute of Chartered Accountants, also holds a bachelor degree from Sri Ram College of Commerce, Delhi. She holds a diploma in IFRS and she is a finance professional having post-qualification experience of more than 9 years, providing financial reporting advisory and audit services to various companies. Her expert knowledge lies in IFRS standards as well as Indian adoption of Ind AS and GAAP conversion. She has addressed complex areas like IFRS 15, IFRS 16 and 9 implementation, including the expected credit loss method. She also has experience on various cross-border engagements and has worked with Australia, Singapore and UAE firms on accounting advisory and consolidation engagements. She is an active trainer internally within the firm as well as externally to clients. So it's a pleasure to introduce Priyanjali Agarwal to all of you, and Priyanjali, thank you so much for being here. I request you to take over the session.
For the introduction, good evening everyone. So as the chairman introduced, that today's topic is regarding common pitfalls in financial reporting and application of accounting standards, where we will cover both Ind AS and IGAAP wherever applicable. So before moving on to the various intricacies, I would just take a minute to talk about the legal framework that we are talking as of now. Of course, we know that the Indian accounting standards or Ind AS, these were notified under Section 133 of the Companies Act. And these have been formed keeping in mind the global standards, which are IFRS. So these are more aligned in conjunction with IFRS with a few carve-outs. Apart from this, we also refer to Schedule 3 Division 3, which is Schedule 3 Division 2 and Division 3. So Division 2 basically talks about the financial statements for a company whose financial statements are drawn in compliance with the company's Indian accounting standard rules. and Division 3 specifically talks about the NBFC companies. So that's the only difference between Division 2 and 3. So we will also be covering certain requirements of Division 2 which are applicable to normal companies, certain disclosure requirements or financial reporting requirements. Now before moving on to the specific topics, we all know that these accounting standards, whether those are IGAAP or Ind AS, they have been formed after keeping in view certain general features or the conceptual framework under which these standards have been formed. These features basically refer to why do we have accounting standards? So that the financial statements can give a true and fair view, a fair presentation of what is happening in the company, what are the financial, what are the numbers of the company. So in order to have a true and fair view of those numbers, these accounting standards have been implemented. They all prescribe accrual basis of accounting. We all know this, that any accounting done under IGAAP or Ind AS has to be on the basis of historical cost convention or accrual basis of accounting. The frequency of reporting, that is also prescribed by the standards, how frequent you have to report a disclosure, let's say impairment requirements or fair valuation requirements, how frequent they need to be tested and how frequent they need to be reported. Consistency of presentation, this is very important, that any standard should not conflict with the requirements of any other standard. If that is so, there has to be certain norms in the standard that which would take precedence, so that there is consistency in reporting. Also, this is important from the point of view of comparison of different companies. So if different companies follow different set of rules and standards, how will you ever compare two sets of companies or two sets of numbers? So that consistency in the presentation is very important for the general public to know that what actually is happening in these companies. Materiality and aggregation. So any accounting standard when we apply or any accounting policy when we give, there has to be a concept of materiality involved. That what is material, what is significant for the users to understand. Comparative information, we all know that whenever we present financial statements, there is a comparative information which is required. In fact, when we switch to Ind AS, there are 3 sets of balance sheets that are required. So comparative information again is very important to understand that in which direction the business is going. What is happening from previous year to current year, whether it is going in a good direction, whether the profits are improving, whether the loans are being repaid, all those things you will come to know only if you have comparative information in the financials. Going concern, again this is something that by default we assume that the company is in a going concern state. Company is expected to continue for the foreseeable future, and that is how we are implementing all these standards. If that assumption goes for a toss, the entire accounting, the entire presentation of financial statements will change. And last is offsetting. So again, which assets and liabilities can be offset against each other, which income and expenses can be offset, or they have to be presented separately in the statement of profit and loss. That is again very important to understand, and it is very important for the users also to see that what actually are the revenue and expenses of the company, because if something is net off, you will never come to know whether that is just a small number or it is composite of 2 big numbers. So again, offsetting rules are very important to understand. So these are just the topics that we would cover. We will not cover everything in detail, so I would not be going through the entire standard because obviously that's like a 2-day job. But we would be covering certain pitfalls or certain observations that even NFRA has come up with, ICI has come up with, or what we have seen in the general implementation of these accounting standards. So the first topic is on financial instruments. Now financial instruments is a completely new concept which was introduced under Ind AS. Under IGAAP there was no concept of financial instruments. There was no particular standard which talked about financial assets. At best we had a standard on investments which gave you the accounting for investments. Apart from that, there was no specific set of rules for financial instruments. So anything which has come up in financial instruments is obviously very new and something which needs to be implemented very carefully. Now, one of the topics that we have seen where commonly we have seen that people are not following the requirements of the accounting standard is on corporate guarantee. Now, we have all seen that their companies give these corporate guarantees to banks in respect of loans availed by their subsidiary companies or by their associate companies. And sometimes the case is that that subsidiary or associate company is getting a loan only because the holding company is providing a guarantee on behalf of them. Now, initially under IGAAP, as we all know, these corporate guarantees were classified as contingent liabilities. We did not use to account for them in the financial statements. It was just a disclosure that this is the guarantee that we have provided. However, under Ind AS, this entire concept has changed. Now, under Ind AS, it says that all these corporate guarantees are financial guarantees and they fulfill the definition of financial instruments. And that is why they have to be accounted in the financial statement rather than just giving a disclosure as a contingent liability. So any holding company, let's say if it is giving a corporate guarantee in respect of its subsidiary, it has to account for it as a financial liability in its books of accounts. So which means that it will have to fair value that corporate guarantee. Now, how do you fair value a corporate guarantee? What is the value of the guarantee that you are giving? Now, generally what happens, these are related party transactions, right? So there is no guarantee commission which the holding company is charging from the subsidiary company. Now, let's say that it is not a related party transaction. Let's say this was a transaction at arm's length with a third party. Then obviously you would not give a guarantee in behalf of any other party without any commission, right? So that commission that you would have charged had it not been a related party becomes the fair value of that financial guarantee, and that has to be recorded as a financial liability in the financial statements of the holding company, and then it has to be amortized and taken to P&L as an income over the period of the loan, because you are providing that guarantee over the entire period of the loan. So that is the accounting which is prescribed under Ind AS. It has also been clarified by an ITFG, but we commonly see that this is being missed in the financial statements.
Ma'am?
Yeah.
What about support letter from the holding company? Let's say for example, it is a subsidiary, but it is under huge losses, R&S are looking negative. There is no concept of loan as such, but the auditors of the subsidiary, they have asked for support letter from the holding company, which they have provided. And would that also be required to be reflected under Ind AS as well?
So see, if the support letter has only been asked by the auditors, then that does not become a financial instrument. But if the support letter is asked by a bank in lieu of providing a loan to the subsidiary, then it becomes a financial instrument, because then there is a contractual arrangement between the holding company and the bank. But if the auditor has just asked it that you provide a support letter that you will support the operations of the subsidiary in order to confirm that subsidiary has a going concern, so in that case it will not become a financial liability because there is no contractual arrangement here.
But would a disclosure be required in the books of the holding company?
In the books of the holding company, no, the disclosure won't be required. This would come in the books of the subsidiary company when they do a going concern assessment. So their entire assessment would be based on this fact that the holding company has provided a support letter. But it does not give you a liability in the books of the holding company.
I think a disclosure would be required in the commitment section, because holding company has given a commitment to the subsidiary. So in my view, at least there you should disclose.
Yeah. In the commitments, yes, but not as a financial liability.
Yeah, right.
Yeah.
I had another question. You said that you have to, the holding company will determine the rate. Now practically it becomes very difficult.
Yeah.
The holding company is not a banking company, it's a mere any other trading or any other concern. How do you determine the rate itself? Can you throw
Yeah,
some?
so the most common method that is used is to go to the bank and ask that if this guarantee was not provided, what is the interest rate that they would have charged? And whatever is the interest rate right now and that they would have charged, the difference between those two can give you an indication that what is the fair value of that guarantee.
But the interest rate is for a year. So technically then only a year cost has to be recorded.
So that year cost has to be recorded over the term of the loan, per annum commission.
So there is no liability as such will come in the balance sheet. Means you said now you have
No,
to
the liability will come because you will see that if the term loan is for 5 years, you will calculate what is your commission over the 5 years, you will calculate the present value of that commission and then record a liability. And then that will be amortized. So it will be for the entire period of the loan discounted to its present value.
But it is not happening between subsidiary and holding. Only third party related issue, only this commission part will come.
Yeah.
We have to recognize in books of accounts immediately.
So even if it is between holding and subsidiary,
Yeah.
if you are not charging a commission, still you will have to record that liability as a notional liability because everything has to be at fair value, right, under index. So we are not charging commission because there is a holding subsidiary relationship, but that does not mean that we don't record that financial instrument. So that income which will come will be a notional income, you are not getting cash in respect of that, but still that has to come to P&L.
The company provides guarantee to the bank in the form of using this land for the associate concerns only
Sorry, can you repeat?
company holding a land.
Uh-huh.
We provide the required collateral security for one of the associates loan
Yeah.
to the bank. How do I evaluate and to be disclosing in the financial?
Yeah, so again, here we are providing a collateral against the loan taken
By a subsidiary.
by a subsidiary or associate.
Associate.
Yeah, so it's the same, even if it is a subsidiary or associate, the accounting will be same. Now here what we are doing is we are providing a security for the loan that they have taken, right? So in this case again, this is a financial guarantee arrangement because if that loan is not repaid by the associate, then the burden of fulfilling that loan comes on the holding, right? The holding has to liquidate its land and then pay off that loan. So the same accounting will come in that case also.
I think the full value of the loan should be taken in the balance sheet.
No, only the guarantee commission. Only the guarantee commission value will come, not the value of the loan.
That has been shown in the balance sheet as well as income.
In the balance sheet, we will show it as a financial liability and then it will be amortized to P&L over the term of that loan.
So, and if the interest rates are floating, that's not fixed, and every year it will change, how do we deal with that
It
scenario?
does not, so see this is only an estimate. It is, this number is not published anywhere or you cannot compute it 100% accurately. So even if we do that estimate on day one, we don't need to change it even if the interest rate changes.
I have say holding and the subsidiary both have taken loan from, just for an example, Bank A, and the respective securities have been given, property, moving forward. Both the companies have given the counter bank guarantees, I mean corporate guarantees, counter. In that scenario, how it should be looked at?
Practically, I'm not sure how this would be possible because if a company is good enough to give a guarantee in behalf of another company, they would not need guarantee from another company. But if it is there, let's say hypothetically, then again the accounting will be done in both the companies. At console level, everything will get eliminated, but at the standalone level, the accounting will be done at both levels. So both of them will record a financial liability.
So financial liability will come, debit will be what?
So debit will be your equity contribution to subsidiary company, because let's say if I am giving a guarantee to a subsidiary company, it's like an advantage that I am giving to him in lieu of that holding subsidiary relationship. So the debit will be equity contribution.
So that will be treated as investment, you mean to say?
Correct. And then we have to test that investment for impairment and all the other nuances will apply. Any other questions before moving on? Okay. Related topic to this, interest-free loans from related parties. Again, no specific guidance under IGAP. We used to record this at carrying amount, but now things have changed under Ind AS. So Ind AS, first we will need to see. So there are two things which are majorly missed by companies. First is that they don't disclose the repayment terms, interest terms of these loans. These loans are just shown in the balance sheet as loans to related party or loans from related party, and no other disclosures which are generally applicable to borrowings or loans are disclosed. So first is that we have to make sure that the repayment terms and the interest terms are disclosed in the financial statements. Second, we need to see whether these are current or non-current in nature. Now typically related party loans, when you go and ask them that is there an agreement, there is no agreement, it's just a verbal conversation or through email, something like that. So we have to first determine that what are the terms agreed. Now if there are no terms agreed, then generally these loans are considered as repayable on demand. That whenever I'll ask for the loan, then they'll have to repay it back. Now if it is repayable on demand, then in the books of the borrower, it always has to be a current liability. They cannot show it as a non-current liability because they don't know when the other person is going to ask for it. In the books of the holding company who has given the loan, they can classify it as current or non-current depending upon when are they expecting to collect this loan. Let's say they themselves know that I will not collect it within 1 year, then they are free to do it as a non-current loan. Now the other question which comes here is that at what value such loans be recorded. Again, we need to record these loans at their fair value. Now because these are interest free, the carrying amount of the loan does not represent its fair value, correct? So we will have to see that what is the fair value, we will have to determine a market rate of interest and then discount that carrying amount to its fair value. Whatever is the difference on day one again goes to your equity contribution like we did for guarantees. So because again that is a advantage that you are giving to your subsidiary by way of giving an interest free loan. So these are all the things that we need to keep in mind whenever there are interest free loans given to related parties or received from related parties. Anybody who has done this accounting practically or has come across this?
So promoter loss have come across.
It's the same accounting, yeah. So
It's a debit is where we have to
equity contribution. Again,
do. Loan is received from promoters.
loan is received from promoter. So on day one you did bank to loan. Then you will discount that loan at its fair value. So let's say the value reduces. So loan debit to equity contribution. Or either equity contribution or if it is a different, let's say it's a fellow subsidiary, then you show as a dividend distribution. But that impact has to go to equity rather than P&L.
Other equity.
Yeah.
Now, in terms of loan, I have seen that a subsidiary company, holding company has given loan to subsidiary company, and the subsidiary company net worth is completely eroded. If they have to, it is no terms and conditions are there. The moment if the subsidiary company has to pay the loan, it will collapse. Means they don't have means also to pay. In that scenario, will you treat the loan as current as or non-current?
So basically you're saying that they cannot repay,
Financial condition of subsidiary company is such that they can't pay.
they can't pay.
How the loan
So
should be
in-
presented?
In that case, that loan should be impaired. That loan should be assessed.
That is
for
like the
impairment.
holding company, subsidiary company I am asking. The liability part, whether it should be shown as current or
Correct,
non-current.
correct. Definitely current. The next topic is on derecognition of equity investment designated at FVOCI. Now let's first understand, refresh our memory. So under financial instruments, any sort of investment, equity investment if we are doing, we have a policy choice to whether carry it at fair value through P&L or fair value through OCI. Now, generally what happens is that there is a business model test before this classification. So entities need to see that whether what is the purpose for which they are holding that investment. Okay, if they are holding that investment for sale purpose or trading purpose, then very clearly it has to be fair value through P&L. Then there is no choice. But if you are holding it in order to collect principal value of that or for a longer period of time, then you have a choice whether to do it through P&L or through OCI. Now let's take a scenario where the company has taken a choice of carrying these investments through FVOCI. Okay. What happens at the time of derecognition of those investments? Generally what companies do, they will derecognize the investment, whatever gain or loss is coming, that will go to OCI and everything will get squared off. But there are certain specific disclosures which are required in that case. So we have to understand that these investments were classified as FVOCI because these were considered as strategic investments rather than investments for sale. So if they have been disposed of, we have to disclose that what is the reason for disposing these investments. Was there a change in the business model of the company because of which such sale has happened, or are there any other events and circumstances which have led to such disposal? So those kind of disclosures should come in the financial statements at the time of disposition of such assets. Again, talking about investment classification only, so like we talked that there are two methods, either FVTPL or FVOCI. Now what are the other disclosures that are required? Anybody who has made those disclosures, reviewed it, audited it? So yes, we have classified the investments. We will obviously disclose that what is the accounting policy that we have opted for those investments, that whether we are doing through PNL or OCI. So that's the first disclosure. Apart from that, there is also a requirement to disclose the hierarchy of its fair value. Now this is a very typical thing which goes wrong in a lot of financial statements. Either they don't give this disclosure at all, or even if it is given, it is presented in a wrong manner. Now there are three levels which are defined in Ind AS 113, level 1, 2, 3, under which the fair values need to be classified. Okay, level 1, very clearly the fair value or the market value of any instrument which is publicly available. Okay, so that only that instrument can be classified on level 1. So if the company has made investment in any publicly listed companies, in any mutual funds that are listed, so only those can be classified under level 1. Level 2 means where the market value is derived using certain inputs which are readily available in the market. So the market value of the instrument itself is not available, but it is derived using such inputs which are readily available. So for example, let's say, so level 2, honestly speaking, we use it very less. Either it is level 1 or level 3. Because the examples that have been given is, let's say there is a company which is in a similar business and that company is listed. So you can use the information available for that company in order to do a fair valuation of your company. But again, that's a very far-fetched phenomenon because all the factors which are applicable to your company might not be similar with any other company. So you would not be able to use that. So generally what happens is we go to level 3 where you do a fair valuation based on certain inputs, estimates and assumptions. So this is generally where we get a fair valuation report from an independent valuer. So if I have made an investment in any XYZ company, I will have to get a valuation report of that company, basis which you will fair value your investment, and that has to be recorded in the financial statements. And then that valuation will get categorized under level 3. And there are a lot of disclosure requirements then for level 3 specifically. So level 1 and level 2, if you have classified anything, we don't need to give any more disclosures. But if we have classified as level 3, then we need to give what is the valuation technique that we have used, what are the assumptions that we have used in that valuation, a sensitivity analysis for those assumptions, everything has to be disclosed. So that's the difference between the 3 levels and how you classify it.
Any restriction as to what should be the age of the valuation report? Like for example, it cannot be older than 6 months or 8 months or something like that.
So see, ideally the valuation has to happen on the reporting date. It even cannot be 1 month or 1 week old. So, and valuation has to happen at every reporting date because you are carrying that instrument at fair value. It is not just for disclosure purpose. That number is coming in your financial statement. So it has to be at the reporting date.
So let's say it is valued as at 31st March, but the report itself could be like say around May. Is that what you're saying?
That is okay. That is not a problem as long as all the assumptions that you have used in the report were existing as on 31st March. That's it.
But thereafter, if the conditions change, certain market scenarios change after May, post May, and the valuation which is shown in the report might not be justifiable to the auditor for the financial for the.
No, but those would be justifiable as at 31st March, right?
So can the valuation report still be used, or should the auditor ask for a separate valuation?
No, no, it can still be used. So see, if any parameters have changed after March, those again would come in your subsequent events. Okay?
No, like not for March. Let's say after May.
Yeah.
The 31st March is the reporting date. May 30th May could be when the valuation report was made for 31st March. Audit is being conducted in the month of August, but in between May and August, certain parameters changed, certain market scenarios changed, and then the auditor might feel that okay, whatever metrics were given or used in the valuation report for 30th May, which were existing as on that day, they may need to be changed. So can the auditor ask for something, or would the disclosure?
No, so that is what I am saying. So even when you are doing the valuation on 30th May, you cannot take into consideration the factors that existing in April and May. You still have to consider the factors that existed on 31st March. And anything that happens after March, whether it is till May or between May to August, all those will be considered as subsequent events. And then we will have to see whether the effect of those subsequent events can be taken, whether those are adjusting or non-adjusting. So whether any conditions existed on 31st March which led you to believe that these things can happen in future. If not, then you have to go by whatever has already happened on 31st March. You can maybe give a disclosure for that these things have changed subsequently, but you cannot take the impact of that in the financial statements.
Are there any observations from NFRA regarding such reporting by any auditor?
Yeah, definitely. So NFRA again on this fair value hierarchy, there are quite a lot of observations that people have not classified this in the correct hierarchy. Plus there were also an observation for a company where they questioned the valuation technique. So level 3, you have to disclose the valuation technique. So they questioned that this is not the technique which is used for valuation of an equity instrument. So why has the company used it, and whether the company has actually used an expert valuer or this has been done in-house. So those were the kind of questions that they raised.
No, adding on to his point, I had a point. Basically says you have taken a discounting rate. The prevailing discounting rate was 10% at that point in time in the month of May in his example. So there is a change in the bank rate, and now the discounting rate has changed drastically.
Yeah.
So your valuation, what you have done on the 31st of March, you have taken the discounting rate of 10%. Don't you think in that scenario, again a new valuation report is required, considering the discount rate which is prevailing at the date of signing of the financial statements? Means closer to that. Say if there is a significant dip or increase, the valuation what you have done will change drastically.
Correct.
So in that scenario, will it not make sense?
I don't think so, because see again, this fair value that you have to report is at a particular date.
Correct. So it
Right.
is calculated based on certain parameters.
Yeah, so we have to look at those parameters at that date rather than at the date of signing.
So then how do you factor subsequent event after the balance sheet date? These are subsequent event balance
But
sheet date
again,
which is
as I said, that we
changing the
have to see
value.
whether this is adjusting or non-adjusting.
It will be adjusting.
How can we say that as on 31st March, there were conditions that existed which led me to believe that the discount rate will change in future? If there are any such conditions, definitely yes.
Mhm.
But if we cannot justify that to the auditor that these are the conditions that existed, then we won't be able to take that as adjusting.
So maybe a COVID related scenario, if something would have happened that was not in existence, say suppose in the month of March, and it happens like in the April, May, June
Yeah.
somewhere, we need not do anything.
Yeah.
If I go by your logic.
But we'll have to give those disclosures in the subsequent events that these are the conditions that happened. Had we taken these assumptions, if there is a very material change in the fair valuation, then that has to be disclosed.
Then I have to report the number also. Had
Number
this
also.
assumption
Yeah.
been be taken, this would be the number that would have appeared.
Correct. But again, this would be applicable if it's a really material change that
Yeah,
would
okay.
take place.
There are many instances of failures of startups. Whenever there is a company who is investing in the startups, where usually these valuers will have certain numbers in place and then they project that valuation numbers. So can an auditor go by this level 3 hierarchy and then still go ahead with that number? This is first question, and then follow-up question is, say in the second year of the audit, I see that the projections of say 20% or 25% which was factored as a revenue increase is not actually 20%, it's only 5% which got increased. And then again the valuer says it is always projected, forecasted, and then he goes up 25%, and then always the valuation numbers he'll try to put more or less the same number. As an auditor, how do we deal with that kind of situations? Any light on that?
Yeah. So, see, a very good question, and I also see my audit team struggling with this. We also do an audit of a lot of startups, and the valuation reports that we get are more or less, you feel those are inflated, but because it is being done by an independent valuer, an expert valuer, you cannot question the judgment of the valuer. The most that we can do is we can get it vetted by another valuer, that whatever assumptions that have been taken or whatever projections that they have taken are correct. The projections, as you say, those are given by the company, right? So they need to justify that on what basis those projections have been taken. Are there firm commitments that they have? Do they have logged contracts on the basis of which those numbers are taken? But yeah, even after that, yes, there can be still be a doubt on the valuation, but I don't think so. As an auditor, we will be able to go any more in depth in that, not being experts in that area.
So there should not be any NAFTA challenges or anything as long as I'm going with it.
Exactly.
I think in that you should challenge the management, because if you have seen that they have last year taken 20% and this year the growth is only 5%, again they are going ahead with 20%. There has to be a strong justification.
Yeah. The
I
projections, as I
think
said,
you have to
projections have to be
document that.
justified
At
by
least
the
you have
management.
challenged whatever assumptions they have taken. You have applied your thought process, you have applied your professional skepticism.
Sir,
I
yeah.
think that should be fine.
Challenging the futuristic assumptions is always becoming a challenge.
That's true,
Like,
but
they,
it's
they always
it's-
come up with a counter argument that says the past, whatever the known reasons that they will reveal. But whatever the futuristic assumptions, it's really out of control sometimes.
In the Excel sheet you can put any evaluation number.
So, should we use SA 620? It is auditing the work of an expert, so that says that we have to check for 6 parameters. Their competence, efficiency, the parameters used and all that. If certain parameters we do not agree with, then maybe we can give a disclosure of the report.
Yeah, we can give a disclosure, and I think in these valuations and these financial instruments, CCPS and all these things that startups have, generally every company gives a key audit matter in respect of that. That because so much of time has gone in auditing that, and it's obviously very important to the entire financial statement. So that I think is absolutely necessary, and if we believe that any of the parameters we don't agree with, then I think an emphasis of matter should be given in respect of that.
When we talk about challenging the management on this, then it can be a long-term discussion and debate on that.
Exactly.
So in the same scenario, like company has invested in some power sector based on the regulatory requirements to purchase the power, they have to invest into the equity of the power generating companies. Now, it is not an intention to earn any income or dividend on it. It is only the intention to purchase the power from them at a discounted price. Now, given this, what kind of a disclosure? This is not actually an investment, it is only a regulatory condition, have to participate in the equity.
Yeah.
So how the policy making should be there in the given scenario?
See, the purpose, yes, as you said, that it's a regulatory purpose, but at the end of the day, it's an investment in equity share. So the business model can change. So as I said earlier, you can decide whether this is for sell or for a strategic purpose. So here, obviously, it will qualify as a strategic purpose. So we can do a FVOCI here instead of FVPNL, but again, we'll have to carry that at fair value. That would not change.
Fair value, I am not participating in any control making decisions of the company.
That's okay. So even if let's say if I invest in a listed company, I invest in 0.1% of their shares, obviously I will not be participating in anything. But I will still do a fair valuation of that investment because it's a financial asset, it's a financial instrument. And as per the standard, has to be carried at fair value. So that does not give you any difference whether you are participating or not participating. That in fact gives you an exemption. If it is an associate or a subsidiary, then you don't have to carry a fair value. But apart from that, it is all has to be fair value.
Again, level 1, level 2, level 3 has to be
Yeah.
followed. If loan is, interest-free loan is taken from government, how the treatment should be?
Yeah, so if it is from government, then it has been specifically included in the government grant standard. So basically, again, you will fair value the loan, but whatever is the difference between the carrying amount and the fair value of the loan, that has to be treated as a government grant. So on day one, you will treat it as a deferred income government grant, and then you will amortize it over the period of loan. Next one is on some of the disclosures. Now, one of the disclosures that we have seen is liquidity risk, right? We all provide this. This has to be provided in respect of all your financial liabilities. So basically what we need to do is we need to show the undiscounted cash flows from each of the financial liability, that over what period of time we have to pay those cash flows. So let's say if we have these liabilities, so what is the total amount that I have to pay in respect of that, the remaining amount, and over what period I have to pay. Similarly, trade payables or any borrowings. So this entire table, less than 6 months, 6 to 1 month, 1 to 2 year, that we have to present as part of the liquidity risk. Now generally what is seen here is, standard says you have to give the undiscounted cash flows. Okay? Everything like these liability or any borrowing that you are carrying at fair value, all those are coming at their discounted values in the financial statements. In the liquidity risk analysis, we have to give undiscounted values. So what is the actual amount that I have to pay, not the present value of that amount. Okay? So ideally what should be the case is that whatever is the total that you have given in your liquidity risk, that should not tally with the total of the financial statement. Because in the financial statement, if we, let's say, take an example of lease liability. Financial statement, I am given what is the present value of future lease payments that I have to make, right? That is your lease liability. So basically, I have taken all the payments that I have to do in future, discounted it and calculated a present value. In the liquidity analysis, I am given what is the undiscounted cash flow that I have to do in future in order to repay my lease liability, right? So this liquidity analysis amount should never match to your lease liabilities. But generally, if you see in the financial statements, everybody tallies these two amounts and that is their reconciliation. But actually, that is wrong. Because
So you mean to say the lease liability future rentals are say 100. We discounted the 60 is the number that is coming in the financial statement.
yeah,
So in the liquidity risk analysis table, you mean to say we need to put 100
100.
and 100 over what period you are going to pay.
Correct. Correct. So that's a very common miss that you can see in the financial statements. Next one is on sensitivity analysis. Now, as part of your market risk, we give different types of risks. Like the standard divides market risk into 3 types of risk: currency risk, interest rate risk, and other price risk. Currency rate, if there are any foreign currency exposure of the company, any assets or liabilities which are outstanding, which are in foreign currency, then that exposes you to currency risk. Second is interest rate risk, if there are any variable interest rate instruments. So if there are any borrowings which have a variable interest, then we say that the company is exposed to interest rate risk. And similarly, price risk, if there are any instruments which the fair value of which fluctuates as a result of market prices. So as we were discussing, if we have made investment in any listed securities, so as and when the market price varies, the fair value will also vary. So these are all the type of market risks which we have to disclose. Now, generally what is seen is that a sensitivity analysis is not provided for these risks. Standard definitely asks you to give a sensitivity analysis that in case the percentage of interest rate changes or the market price of a security changes by, let's say, 1% up or 1% down, what will be the impact on your profit or loss. So that sensitivity analysis has to be provided for each type of market risk. There are no fixed rules as to how much percentage you should increase or decrease. Whatever seems to be sensible from the company's point of view, how material the numbers of the company are. Depending on that, we can either do 1% or 5%, whatever seems suitable for from the company's perspective. But that sensitivity has to be provided in all these three types of risk.
What about conflicting regulations in this case?
Sorry?
What about conflicting regulations? Let's take for example, a company, it could be a banking company, in the banking domain, it has certain exposure in foreign investments, foreign assets. And Companies Act, Accounting Standards may define certain ways to disclose it or certain regulatory parameters to disclose it, which might be at conflict with what the RBI may prescribe. In that case, what should we follow?
See, for financial institutions, for NBFCs only Ind AS is applicable, not applicable for banks right now. But even for NBFCs, a lot of guidances have come in now. Earlier, this was a lot problem, especially with respect to your provisioning, because Ind AS says you do it as per ECL model. RBI provides you different guidelines. But now, after the adoption of Ind AS, most of the things are now aligned with Ind AS. So, unless and until there are any extra disclosures which the RBI has asked for, which obviously are being provided by NBFCs, all the other disclosures or all the other accounting is happening now as per Ind AS.
This was specific to Ind AS or banking sector. For example, data storage. Our Companies Act, it mandates companies to store data locally within India, Indian servers. But a company which is, let's take for example, a subsidiary, 100% subsidiary of a foreign company, it might store its data in foreign servers as well. In that case, would that tantamount to foreign exposure, and should sensitivity analysis be done for that as well?
It will not tantamount to foreign exposure, because again here we are talking about exposure of financial instruments. This risk that we are providing, it's a financial instrument management risk, right? So those, the kind of risk that you are talking about, those are very different from financial risk. Obviously, other Companies Act rules will apply on that, and the audit trail and all those things have now come in picture. But specifically, if we talk about these risks, these will not be applicable there. Yeah. So next, we move on to provision matrix as per ECL. Now this is obviously one area where I think if you look at 100 different financial statements, everybody is just following their own methodology of making ECL model as well. So there are a lot of varying practices. But yeah, a couple of things that we should keep in mind. First is, a lot of places it is seen that they feel that ECL needs to be done only for trade receivables. So first of all, that myth needs to be busted. ECL needs to be done for all financial assets, whether it is your cash and bank also. You analyze it, you say you have zero provision, but that analysis has to happen for every financial asset. Whether it is other receivable, whether it is deposits, whether it is cash and bank, contract assets, any kind of financial asset, an ECL assessment has to be done and disclosed in the financial statements. Second is how the disclosures should come. Now, standard gives a lot of disclosures regarding ECL. There is a very long para 35 which is coming on ECL disclosures. But few things that we should keep in mind is, first of all, that the entity has to disclose for every financial asset that what is the gross carrying amount of that asset, what is the ECL created, and what is the net carrying amount. So that table has to come. And again for all financial assets. Okay. Second, they also have to disclose what is the credit rating grades of those financial assets. So basically we have to disclose that how high or moderate or low the risk is on those particular assets. Now let's say for example cash, we say that the risk is low. Why? Because these are kept with reputed banks, they are highly liquid, their value cannot change. So all those things need to be provided in the disclosures. Similarly, if we have any trade receivables, which we have already classified as doubtful, so then those we can make a separate bucket and tell this is high risk. The others we can classify as moderate risk. If there are any trade receivables which are secured by any deposit or anything that we have received from the customer, we can classify it as a low risk because these are secured against certain deposits. So that classification and a table saying what is the gross carrying amount, what is provision, what is net carrying amount, that has to come. Second, there has to be a provision matrix. Now provision matrix is specifically in the standard also, if you see, they have given example for trade receivables only. That you classify your trade receivables between different buckets and then you tell that what is the percentage of ECL that you have created for each bucket. Because for each bucket there has to be a different percentage. You cannot create a 10% provision for something which is not due and also for something which is due past 2 years or 3 years. Okay, so that provision matrix should come, that where are you creating 100% provision, where are you creating 60%, where are you only creating let's say 0.5%. So again that matrix should be provided as part of the disclosures. And another important thing is that as part of the accounting policies, the company should always disclose that whether they have opted for simplified ECL model in case of trade receivables. So the standard gives only one exemption in case of trade receivables or contract assets, that you can follow the simplified ECL model, which means that we don't need to bifurcate between 12-month ECL and lifetime ECL. We can create a lifetime ECL for trade receivables without assessing that whether it is in stage 1, stage 2 or stage 3. But this is not allowed for any other financial asset. So all the other financial assets we have to see which stage they fall in, and accordingly we will have to create a ECL provision for them. Now practically if we see for companies other than financial institutions, NBFCs, trade receivable is the only financial asset where a provision is created. All other assets we are able to say they are either secured or they are with reputable agencies, so there is no, their carrying amount represents their fair value and therefore there is no provision required for them. But that disclosure still has to come even if we are not creating any provision. For trade receivables where we are creating a provision, generally what we do is that we analyze these, the aging of these trade receivables over a period of 4 years, 5 years, whatever is available with the company, and on that basis we come up with that provision matrix, that how much percentage of ECL should be applied on each bucket. So that whatever methodology that you are using to actually create the provision, that should be disclosed as part of the financial statements. Another point relating to disclosures. Now, as we talked about loans to related parties, whether we have taken the loans or we have given the loans, a lot of times what you see in the financials is that they have not subclassified these loans, whether these are secured, unsecured, whether they are considered good or doubtful, whether they are to related parties or third parties. All these bifurcations need to be provided mandatorily in the financial statements. These are apart from the repayment terms and interest terms that we talked about. Apart from that, these classifications should also be given in the financials. Any question on financial instruments before I move to the next topic? So whatever we discussed.
The advance given for supplies, can it be considered as a financial instrument?
That would be a non-financial asset.
Okay, but in effect, it's basically say the facts are like this. The subsidiary is in cash crunch. Maybe the holding company wants to pump in some money and call it as an advance for supplies made. But still, the content of the agreement still says that there has to be certain future supplies to be made against that advance made, maybe in the next 10 years or so. Can it still be classified as a non-current or non-financial instrument?
See, financial instrument standard goes by contractual arrangement.
It's not substance over form.
Yeah. So here, if we have a contractual arrangement which says that this is to be adjusted against supplies, and the subsidiary never has to repay it in cash, then we can't classify it as a financial asset. Okay, so revenue recognition, one of the topics that personally I have come across where the entities just miss to apply this guidance is on combination of contracts. Now again, this guidance was not there under IGAP. IGAP we had a very simple revenue standard, but now under Ind AS there is a specific guidance on this combination of contracts where it provides you that what are the factors that you need to look at in order to see whether any contract with the same party needs to be combined and looked at in a singular way. So let's take for example that this company enters into a contract for the sale of specialized equipment. At the same time, it also enters into a second contract for significant customization and modification of that equipment. Okay, so there are two separate contracts. One is for the sale of equipment and second is for the significant customization of that equipment. Now whether we need to look at these contracts together or separately, that is what we need to decide as per this guidance. And what will be the effect of this? So basically your ultimate objective is to see whether there is a single performance obligation or multiple performance obligations in the contract. And if there is a single performance obligation, what should be your timing of revenue recognition, whether you record it at a point of time, whether you record it over a period of time, right? So all those things will vary depending upon your assessment that whether this is a single contract or multiple contract. Now the factors that the standard says that you need to look at it, first, were the contracts negotiated together with a single commercial objective? So here we talk about what is the substance of the transaction, that what was the commercial objective of entering into this contract. Do I wanted only sale of equipment? Can I get the customization done from anyone? Or that customization has to happen from that particular vendor only? And it's just a way that you have entered into two separate contracts, but ultimately you had to do both these things with that vendor. So that commercial objective needs to be seen. Second, does the consideration paid in one contract depend on another contract? Are there any discounts relating in both the contracts that okay, if you do the second contract with me, your combined consideration would be this much. If you don't do the second contract, then the consideration would be this much. So all those factors also need to be taken into consideration. Are the products promised in the contracts a single performance obligation? So again, we'll have to go back to the definition of performance obligation. We'll have to see whether these are distinct performance obligation or a single performance obligation, and then conclude whether the contract should be taken together or whether they should be considered separately.
And what about cross contracts? Like one contract is given by the holding company, the other by the subsidiary company, or in case of joint ventures or associate companies?
In those also, if those are revenue contracts, relating to revenue contracts, again you will have to do this assessment. Now, as I was talking about identification of performance obligation. Now, this is again a very important thing that we have to look at when applying Ind AS 115. That what are the performance obligations, what are the promises in the contract, and then whether those promises are distinct or not. So, how do you identify a performance obligation? There are two conditions. First is you have to see whether the customer can benefit from that particular promise either on a standalone basis. So if I only provide that one service to the customer, whether there will be any benefit to the customer or not, or whether he needs to take the second service from me in order to derive any benefit from the first service. So that has to be taken into consideration. And second is whether that promise is separately identifiable from other promises in the contract. So are all the promises in the contract significantly integrated with each other, whether there is significant customization, like we looked at in the previous example, that you are selling an equipment but you have to do customization, a lot of customization in order to make that equipment available for use. So then entire thing becomes a single performance obligation, because there is no benefit to the customer unless and until I do those customizations, right? So those kind of things need to be taken into consideration when we are identifying any performance obligation. Now we have an example here. So let's say there's a software developer which enters into a contract. Now these are all 5 promises in the contract. One is transfer of software license, perform installation service with substantial customization to add functionality and enable interface with other customized software, provide unspecified updates and tech support for 2 years. And the other thing which is given is that the entity sells these license, installation and tech support separately also, and the other entities can also provide customization. So there are basically 3 things that I am providing. One, I am selling the software license. Second, I am providing substantial customization. And third, tech support for 2 years. Now, how do you identify performance obligations in this? 1, 2 or 3?
Clubbed as one and third as another performance obligation.
Okay, so 2 performance obligations. Anybody with any other opinion?
There should be 3.
3 performance obligation, everything separate. Okay. So yes, I think the third one, everybody knows that will be a separate performance obligation where we are providing a tech support for 2 years. It's a completely different service. First 2, again it is debatable that whether you take it as separate performance obligations or not. The factor which is in favor of single performance obligation is that it is a major customization. The license will be useful to the customer only when these customizations have been done. The factor which is against that is that the other entities can also provide this customization. So customer has an option to get it from get the license from you and get the customization done from any other party. So again, in these cases, the facts and circumstances have to be looked at. How often does this happen that you sell the license and the customer takes it from third party, or is it like always you only do that customization? So is there any cost benefit that will go to the customer if he gets it done from one party only? So all those things will have to be looked at in order to conclude whether it will be single or multiple performance obligation.
Practical scenario, I think it will be always 3 options, because technically a company will always want to record revenue upfront.
Exactly. So if they do it as 3, they can record the revenue from license on day 1. And then the customization can be done over a period of time, and obviously tech support can be done over a period of time. But again, as auditors, we will have to, deep dive into it to see whether it is really a
Usually
single or
major portion
multiple.
of the such companies get the revenue from the customizations
Correct.
because that is predominantly
Exactly.
the revenue driver for them.
Yeah. Sale of software license is just a off-the-shelf
Yeah.
license for them, which they can sell it to anyone. But the major benefit that the customer is getting is from the customization.
What
So-
if hardware is also supplied as a part of the contract?
Yeah, so that again we'll have to see whether that's a separate performance obligation, that
That is
sale
a
of
part of
hardware.
the installation overall contract.
Hmm. So again, if it is part of installation, most likely it should be single performance obligation, and you should recognize revenue over a period of time where you factor in the cost of hardware also in your percentage of completion method.
No, I think there would be a difference in thought. Basically, what is happening in, say there is a turnkey project that you get, that you supply the hardware, you supply the software and do all these things. So once the hardware is supplied, hardware itself means the say laptop or the PC, whatever you call
Yeah.
it, you can recognize revenue upfront. That is a separate performance obligation.
No, that's not a separate performance
Because it has a
obligation.
saleable in.
See, again, we will have to go back and also look at what is the commercial objective of the arrangement. The arrangement was not to buy a laptop or a PC from you.
Correct,
right?
but some other party can also do the customization and all.
That's
Everything
okay.
is
So that is
possible.
what I am saying, that is not the only factor when you decide that it's a single performance obligation or multiple performance obligation. That the other party can provide it or not. Even if the other party can provide, I still need to see that what is your objective of entering into that arrangement. If let's say my objective is how the arrangement or how the agreement is worded it is written that you have to install this software and do these services. Now whatever comes as part of that installation, everything becomes your responsibility. So I cannot break my performance obligation into each and every activity that I do for the customer.
So, but the contract is you supply me 100
Then
laptops
it is,
and
yeah,
then input this software and then you do
then it's
customization
very clear,
and
yeah. Then it's very clear that these are different parts of the contract. And then you should also see how you divide your consideration, because that generally what happens is when the contract is worded in a manner that you have to just provide the entire service, then the consideration also is not broken down into different parts.
consideration is one, but these are the things in the contract I have said.
Even
Then
in
it has
that
to be
case,
decided.
yeah. Even in that case, you can bifurcate the consideration depending upon the relative standalone prices of each of the performance obligations.
I just have an add-on question to that. Say it's a railway project where I'm the material provider plus commissioning also I do.
Okay.
Two elements that I do. And predominantly maybe it is a 70% of the pricing is predominantly from the supply of material. 30% is, now there are two facts now. The other customer doesn't get the benefit out of this entire project unless the entire equipment is installed and tested. Now the PO also says as and when the materials are supplied, the ownership is transferred and then the payment also can be received. So in this circumstance, how do I consider as a performance obligation? Which one should I go with the performance obligation?
See again what we were discussing, that what is the objective of the contract. So if the objective of the contract is to just deliver the end result, then everything becomes a single performance obligation and everything should be on the basis of percentage of completion method. Because and again you will have to first assess whether the conditions of overtime recognition are satisfied or not. But if they are, then the entire thing should be seen as single.
But the commissioning can happen from another party as well. So need not necessarily by the equipment provider. The
So that's
installation
fine,
can
but what
happen.
have you entered in the contract for? Have you entered in the contract for which says that you have to provide these materials? That is one promise that you have made. And second is you have to do the commissioning.
Those
In
do not-
that case, yes, you can bifurcate.
Yeah, can identify the two promises go as bundled. I mean, both the promises can be seen in the same document.
Both the promises, yes, can be seen, but what is the ultimate objective of the contract, that we will have to see. See, any agreement, it starts with recitals and objectives, right? So, what is the objective there? Have we bifurcated our promises there, or have we bifurcated it within the contract where we are saying that as part of this general service, I will provide this service? So, there we'll have to apply our judgment that ultimately what is the objective of that revenue contract. If it is to provide a completed service, then it is generally advised not to bifurcate
The
between
objective is
different.
very subjective. I mean, if I
Exactly.
ask the customer, for him the objective is always the end result. From a service provider perspective, for him it is always two. So that is where.
No, but again, you will also have to see like what are the termination options. Is there any termination penalty? Is the contract such a way that okay, if you provide the material and you terminate the contract, there is no penalty for you, and they can get it commissioned from anywhere else? Then yes, it's an indicator that these are multiple performance obligation. But if there are no termination option, or if there is a significant penalty, or let's say if you can terminate only if there is a breach of agreement, so in those cases it signifies that the agreement, the objective of the agreement is to provide the entire service rather than two different services. Another interesting concept in revenue recognition standard, it is on variable consideration. Now we've all heard of that, again a different concept under Ind AS as compared to IGAAP, where it says that if your transaction price has any variable amounts, let's say any performance related incentives or any volume related discounts, so anything the value of which can vary depending upon any other variable. So then you account for those variable consideration in the transaction price on day one itself. basis the expected probability of that event happening and what is the most likely amount that you will get. But there is another line in the guidance which says that these variable amounts should be estimated and included in revenue to the extent that it is highly probable that the revenue will not reverse. So there has to be a constraint that has to be applied when doing the assessment for this variable consideration. I have to see that whatever amount that you are including in the revenue, there is a high probability that the revenue will not reverse in future. So if I am accounting for 50,000 variable consideration, there is a high probability that I will get it and I will not have to reverse the revenue in future. So that constraint has to be applied whenever we are accounting for any kind of variable consideration. And it also has to be disclosed as part of your accounting policies. Right? So if you take one example here, which says landowner sells land to developer for INR 1 million. Landowner is entitled to receive 5% of any future sale price of the land in excess of 1 million. Okay? Now, landowner's experience with similar contracts is of little predictive value and uncertainty is not expected to resolve in a short period of time. So there is quite a lot of uncertainty here whether he will be able to receive any value in excess of 1 million, and therefore it is advisable here not to account for that additional 5% on day one when you are recording the sale amount. In future, let's say if he is able to sell in addition to that 1 million and he is eligible to that 5%, you record that 5% on that day, but you don't record it on the day when you are recording the sale transaction.
Ma'am, how would you account for that in case of interim transactions? Like for example, there is an entity in the hotel industry. It is being consolidated or taken over by another player in the same segment. Let's take for example on 31st of December. So interim reporting needs to be done over there. Now based on that, if we are going by that logic, then for the remaining quarter, January, February, March, then certain things might need to be taken. For example, if that particular hotel entity which was taken over, it might have a management contract in place with a player who's basically providing it management services going by the asset right model which most hotel chains are doing these days. The hotel chain might have certain commitments, and if those are done, like if certain sales are achieved, then they will also get a certain portion of the revenue. Now, how would we go about reporting that, given that during the middle of the year, that particular entity, the hotel, is acquired by another player?
See, the acquisition part will not make a difference. Let's say the acquisition is not happening, okay? Even then, whenever you are doing that sale transaction in the books of that subsidiary company or whoever is getting acquired also, they will have to again do an assessment of whether they would be eligible to receive that additional amount or not, whether they will reach that sales number and then be eligible to receive that amount. So the same assessment will have to happen in the books of the acquirer as well. So the fact that it is getting acquired will not make a difference in the revenue assessment.
No, what I am saying is that as on let's say 31st March, interim accounts are being prepared. We also have to follow this variable consideration portion. Like if, for example, quarter 4, I have 100,000 rupees in billable every month. 3 lakh basically, I am having a revenue every month. Then going by that logic, I might have to spend 5% to a certain player as well. Do I account for that, both these certain
Yeah, again that the constraint value that we talked about here, if it is highly probable that you have to do that 5% thing and they will reach their target, then yes, you should.
In the previous example, how is it treated in the developer's books? Should they create any cost provision or something?
Yes, obviously. So the provision should come in their books also, depending upon what their expectation is of that payout going on. So that will come under the definition of provision because it is related to a past event, that obligation.
So when you especially say it is a little predictive, we cannot know what is the future penalty. How do we create the provision, that is still a trigger to create a provision?
See, that provision thing, again, we'll have to do under assessment under the particular standard. But I would say that if there can be a situation where the person has not recognized a revenue but the other person has created a provision. That can be a situation, because going by the prudence method, you will record a revenue only when it is certain. You will create a provision even if there is a little certainty. Then if I come to the disclosure part of revenue recognition, now there are a lot of additional disclosures which have been provided under Ind AS 115 as compared to the earlier IGAAP standard. So earlier IGAAP standard, I think we just provided the revenue breakup in the schedules, notes to statement of profit and loss, and that was it. But now there are a lot of disclosures as part of the accounting policies. We need to give an accounting policy specifically for each component of revenue. Then we need to tell that what are the performance obligations identified in those revenue streams. Are there any significant payment terms? When is payment typically due? Whether the contract has any significant financing component. So is there any contract where you are expecting to receive revenue after a period of 1 year, which is, and 1 year basically refers to the operating cycle of the company. So anything beyond the operating cycle of the company. Then is there any variable consideration that has been assessed and included? So all those types, let's say if we are recognizing revenue over a period of time, what method are you using, whether you are using input method or output method. Then if there are multiple performance obligations, how have you bifurcated the transaction price between different performance obligations, whether it is on the basis of relative standalone fair value, whether it is cost plus margin, or whether you have used the residual method. So all those things have to be put in the policies or notes that are coming in the financial statements. The entire process that you have followed, the entire 5-step process, the entire assessments that you have done should form part of the financial statements rather than just a small accounting policy. Then there are also disclosures on disaggregation of revenue. This is something which is commonly missed in every financial statement. Generally what people do is that they have provided the revenue breakup and that is it. But the standard says that you have to disaggregate the revenue on different parameters. So one can be on the basis of products, on the basis of different revenue streams, then on the basis of geography, if you are providing in different geographies, then on the basis of timing of revenue recognition, that how much revenue you are recognizing at a point of time, how much revenue you are recognizing over a period of time. So on these different parameters, we have to disaggregate revenue and show in the disclosures. Then if there are any contract assets or liabilities that we have recorded, so typically the unbilled revenue or the unearned revenue that we used to record earlier, now the nomenclature has changed to contract asset and contract liability. So if we are recording those, what is the movement of them? How much was outstanding at the beginning of the year? How much you recognized as revenue from that contract liability? And how much is left at the end of the year. So that kind of movement also needs to come. And if there are any significant changes that have happened in contract asset and liability, then that explanation should come as a qualitative information. So a lot of detailed disclosure should be given with respect to revenue now. The next topic that I would like to discuss is on intangible assets. Now, intangible assets, as long as we have computer softwares, I think it's quite pretty easy. We just apply a 4-year or 5-year useful life and amortize it over that period. The complexities arise when we have any assets with indefinite life. So any trademarks, any patents, copyrights, such kind of things where no useful life can be provided for that asset. So what to do in that case? Now in that case, the guidance says that we have to test them for impairment. Because we are not providing any amortization, therefore an impairment test is mandatory for these kind of assets. Now what is the frequency of this impairment test? It has to be done either annually or if there is any indication of impairment that arises. So minimum it has to be done annually. Even if there is no indication of impairment, then also we have to do an annual impairment test. But within the year, also if there are any indications of impairment, then you can do a more frequent impairment testing. And then let's say on the basis of your impairment testing, we come to a conclusion that there is no impairment. Okay. Still, the entire assessment needs to be disclosed in the financial statements. What are the different cash generating units to which we have allocated, then what is the recoverable amount that we have identified, whether we calculated the recoverable amount on the basis of value in use or fair value, how did we calculate value in use, how did we calculate fair value, then and the carrying amount is is higher than the recoverable amount, that assessment, what are the assumptions that we used, sensitivity analysis of those assumptions, everything needs to be given as part of the disclosures. So, and that is it is the same for goodwill impairment, it is the same for intangible assets with indefinite life, that impairment testing. And one very interesting thing that I came across in one of the financials was that they used the word infinite useful life. Intangibles with infinite useful life. So again, we have to be careful here. These are assets with indefinite useful life, which basically says that their useful life cannot be determined. These are not assets with infinite useful life, which says that they have unlimited useful life. So yeah, the same things that we talked about, assets with indefinite useful life, same applies for goodwill as well. So if there is any goodwill that we have acquired as part of any acquisition, then again it has to be tested for impairment at least annually, and all the disclosures that we talked about need to be disclosed even if there is no impairment clause during the year. Now, a lot of companies and especially the startups these days, we see that there are certain research and development expenditure that they do. If they are in any tech industry or in such kind of industry where R&D is a major expense, so there is a R&D expense coming in the financials. Now, what you will see is that in the accounting policies, they don't make any bifurcation between what is research and what is development phase. And as per the standard, it is very clear that you have to have a bifurcation, you have to have indicators showing that what was your research phase, where you was just researching an idea, and what is the development phase. So in development phase, basically you can corroborate the reliability of that idea, you can show that this is what the future business plan will be, these are how you are going to earn revenue and all those things. So only the expenditure in the development phase can be capitalized as an intangible asset, and any expenditure in the research phase has to be taken directly to the statement of profit and loss. And the standard also goes on to say that, let's say if you are not able to bifurcate between research and development phase, then everything needs to go to P&L. Then you cannot capitalize anything.
Practically how this happens, because I have never come across anywhere we see people say it's on development. Nobody has claimed it is research and take it in P&L.
Yeah. So I think that is where the work of an auditor comes in, to question them and literally understand from them that what are the nature of expenditures that they have done, and what stage of development are they in right now.
So I'll tell you, practical, so let's not talk about theory. There are 10 people who are on the payrolls of the company. For 1 year they are developing something, some software, some coding and all, which as a chartered accountant I am not privy, or I don't have any idea, let me put you very frankly, or some IP that is getting developed. Now when it was in research phase, suddenly when it became into development phase, I don't have a clue. I can only test that okay, these 10 people were deployed, okay, for this project I can take some management representation, can work around, do some basic maths around it. But beyond that, how to identify it was a research phase or development phase, as a CA I fail to understand.
No, I get your point, and generally what test we also do is, generally we see that companies, as you said, are developing any software, internal purpose software or something like that, right? In these kind of projects, the risk of failure is very less. So these are more or less on day 1 or let's say day after a month, you know what you are doing, you know that this is how this is going to develop and this is the expenditure that you are going to do over a period of 1 year or 2 years. Right? So in those cases, it is still okay to assume that everything was a development phase. But where the company is in a pre-revenue stage, where they are doing a research on a new idea itself. Like for example, I'll give you a example. I currently am working with a Netherlands company who are researching on making flying cars. Now that is completely something that can go for a toss any day, right? You don't know whether they will be able to do it or not.
No, that is very generic. You have picked it up. Means this you can correlate with your common sense. But something which is not correlated. Say I say some IP I am developing, or say some formula or some drug I am developing,
Yeah.
which is very new.
Yeah.
You don't know. You are not a medical
Definitely.
practitioner.
There we don't know.
We can also ask for the impact report or assessment report from the
That the management will only provide. That they will say we are in development phase, this has happened, and in development phase also product can fail.
Yes,
When the research
definitely.
has happened and when development it has gone.
No,
Anything
drug
can.
companies, you are absolutely right that we don't have the expertise to analyze whether it is actually a research or a development phase. We can only get an impact study from them, we can get a management representation letter from them, but that's the max that we can go.
The situation.
MRL is reliable.
Sorry?
How we can rely on MRL?
That's just as I said, we can get an impact study, we can ask those questions from them. MRL is just for our understanding that okay, this is whatever you have said, you actually just provide that in writing.
I think if it's too technical, we can always involve experts. But that is again on standard is what the guidance is. But practically, it is very difficult to refer to an expert in
Yeah, expert also, the company will not be open to share these details to expert when an outsider.
So especially for pharma companies, they would not allow any expert to comment.
Or for that any matter, you know that is the IP you are developing something.
Correct.
If the statutory auditor cannot distinguish between research and development, then no regulator or anybody else cannot either. In that case, we can just use our best judgment.
Then we have to go by whatever management is saying.
Then in every case it is the same,
No, but they have to. That I get your point. That whatever they have to prove, the management will prove that no, we have everything in place. All business plans are in place. Everything will
In
happen
fact, they
according
will.
to that.
The another point which will touch upon research, if it is intangible under development, you need to do impairment
Yeah.
testing also.
Yeah.
So how much cash flow? The product itself is not ready. Cash flow and all, everything is there.
Yeah, that obviously
And
they
I
will
have
be
not
able
come
to
across.
do.
Maybe you can guide me. Have you come across where any impairment has been provided on intangible under development? Anywhere you have
Not
seen?
where I would have done, because as you said, everywhere everything is justified. So not where practically I have done.
See, what I can throw some light here is that timelines. Like if any new recruitment has happened, that gives a perspective it is still in the early stages. So if we catch up the timeline tracker, we may get some perspective what
No, it can be
management is
delayed, data.
feeling.
You can always, again also I can play
And
around.
aging again, if the development cost is not translating to revenue,
No,
maybe
yeah,
in the next
that-
couple of years,
I mean,
that is
those
again
are
an
still
indication.
indicators or something
Indicators,
like
yes.
that, but
Yes.
management can always prove otherwise.
Yeah, it will take 10 years of research. Research can be any period. You can't define research and development.
No, I agree that these are very subjective and judgmental areas where depending upon the kind of documentation that you have been provided, your view can change.
Yeah.
Okay, moving on to next leases. Now this is a relatively new standard which was introduced in DES 116. Earlier we were in a habit of bifurcating all the leases between operating and finance lease, whether it is from a lesser perspective or a lessee perspective, right? Operating leases, we used to just record the rental amounts in P&L. Finance leases, we recorded the assets in our balance sheet and recorded a depreciation and interest cost. Now with the introduction of 116, essentially if we see, everything has become a finance lease, everything is on the balance sheet now. except two exemptions that have been provided for short-term leases and low-value asset leases. So now it also becomes important now to identify that what agreement will qualify as a lease and which agreement will not qualify as a lease. Now the definition of lease that is given under 116, it says that a contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. So there are two important factors here. One is the identified asset. There should be a particular asset identified in the agreement, then only it can be a lease agreement. If the lessor has the right to substitute the asset with any other asset without taking the permission of the lessee or without any reason, then that is not an identified asset and that would not be a lease contract, then that would be a service contract. Second is that the lessee has the right to control the asset. Now, right to control the asset, the standard says that you have to look at it from two parameters. One is whether lessee is getting the economic benefits from that asset, and second, whether the lessee has the right to direct the use of that asset. So if both these factors are there, then we can conclude that lessee has the right to control the asset and it will be a lease contract. Now let's look at one example on this. We say ABC Limited is a car manufacturer. It has entered into an arrangement with a supplier, XYZ Limited, for supply of minimum quantity of power needed in its production process for a specified period of time. So they have entered into a contract where ABC Limited will get a minimum quantity of power. Okay. Now XYZ builds a power plant near ABC Limited's plant to produce the power. XYZ maintains ownership and control over all significant aspects of operating the facility. The power plant is explicitly identified in the arrangement and XYZ has the contractual right to supply power from other sources as well, which are located in other cities. However, this is not economically feasible or practical. XYZ has the right to provide power from the facility to other customers and to remove and replace the power plant's equipment and modify or expand the facility whenever it enables it to do so. So now, whether this is a lease contract or a service contract?
This is service contract.
Service contract? Everyone service? Why? Do we have an identified asset here?
Yes.
Yes. The power plant is there is a minimum quantity of power that ABC has to take. It is written that the XYZ can provide power from other sources as well, but it would not be economically feasible for XYZ. So that is not a substantive right of substitution with XYZ. Therefore, we'll say there is an identified asset at least. Now, second condition is right to control.
Control is not there.
Control is not there. Why is control not there? Because first of all, I am not receiving all of the economic benefits from that asset. XYZ can supply power to any other customer whenever it wants to, right? So if I am not receiving economic benefits, then I don't have control over the asset.
Just adding one point here. If ABC is deploying its people to ensure that the power is generated at full capacity, so that the ABC gets benefited.
But ABC will still take that particular portion of power, right? It has not contracted to take all the power generated. And that is why we say that it is not taking over all the economic benefits of that power plant. So even if it is, let's say if they can hire their people to go and see whether it is done,
Maintenance.
so they have the right to direct the use of that asset. That condition will be fulfilled because I am supervising how the asset is being used, but I am still not getting all the economic benefits. Second interesting topic on this leases is lease and non-lease components. Now we would have seen in a lot of agreements that along with a rental there are certain maintenance expenses, other things which are included as part of the rental, right? So how do we bifurcate, whether we should bifurcate or we can take it in one go only? That is again very important to ensure what is your asset and liability sitting in the books, right? So the standard says that if there are lease and non-lease components, firstly you identify what are the lease and non-lease components and you should account for them separately. But if it is impracticable to bifurcate, then you should consider everything as a lease component itself. So that's a practical expedient which is provided in the standard. Now, generally, if we see in this example also, there is an annual lease payment of 1,30,000. These lease payments include 20,000 for maintenance and 10,000 for administrative tasks. Now, what is the lease and non-lease component here?
1 lakh is lease component, others are non-lease.
So, generally what happens is that we say that okay, 130 is rent, 20 is maintenance, 10 is admin, so both that 20 and 10 becomes your non-lease components. But we also have to see here, so basically what the standard says is that whatever is a non-lease component, you account for it under that particular standard, right? Now maintenance service, yes, it's a service contract, we are getting certain maintenance services, we are paying for that. Administrative tasks, we will have to analyze whether these are any services which are being provided to us or it's just a breakup of cost for the owner. That for their purpose they have just broken down the cost into different categories. If we are getting any services, then yes, it should become a non-lease component. But if we are not getting any services, then it should be clubbed with a lease component only. Again, if I talk about the disclosures on leases, so there is a lot of discrepancy in the terminology that people are using. Somewhere it is being shown as leased assets instead of right of use assets. The liabilities they are still using as finance lease liabilities. So ideally the word operating and finance should not be used anywhere now whenever it is from the perspective of lessee. It is all lease liability, right? There is no finance lease liability now. So that is something that we should be careful of. Maturity analysis of lease liabilities, I think we talked about that earlier, that how do we show the undiscounted cash flows from a lease in the maturity analysis. Then the accounting policy for short-term leases and low-value asset leases, that needs to be disclosed. So short-term leases, very easily, any lease which is less than 12 months is classified as short-term lease. Low-value asset, there is no guidance in the standard, there is no amount mentioned in the standard. This amount has to be determined by the company basis their transactions, basis their materiality, and it needs to be disclosed in the accounting policies, and the company should not change it from year and year. It should be applied consistently. Similarly, another miss that we see in the financials is a lot of times there is a rental income which is coming in the financials, but there are no accounting policies which are given as part of your notes with respect to that lease income. People are generally giving the Ind AS 116 policy as a lessee, but if there is a rental income, then we should also give the policies as a lessor, and then those are the same policies that you have to bifurcate it between operating and finance lease and accordingly recognize income. Investment property, so first of all, I think the classification of investment property, again, it's a new concept, it's a new terminology. Lot of places we are seeing that people, even if there is a rental income, so the first indication that investment property should be there is a rental income, right? So if there is a rental income, you should always go and see whether something needs to be classified as investment property. And more often than not, it would be classified as investment property. So any land or any property that the company is holding in order to earn rentals or appreciation in the form of land appreciation should be shown as an investment property. Now there is a difference when we look at the Ind AS standard and the IFRS standard on investment property. IFRS standard gives you an option to either carry it at cost or revaluation model. Ind AS asks you only to do it at cost model. So similar to your PPE, you carry your investment property at cost less depreciation. But there are disclosure requirements where it says that you have to disclose the fair value of that investment property. So whether you are carrying that investment property at fair value or not, a fair valuation has to happen for any investment property, because the disclosure needs to be given that what is the fair value, what was the change in that fair value from previous year. All those opening to closing movement needs to be given for investment properties. Then another disclosure which gets missed is that what are the direct operating expenses which are arising from that investment property. So basically what they have given is that you give a separate sort of P&L for that investment property. What is the rental income from that investment property? What are the expenses on that investment property that are generating that rental income, and expenses that are not generating the rental income. So all those things need to be disclosed along with the fair value of that investment property.
A company has subscribed for allotment with the government for the land, but the allotment has not been completed by the government. Now this is neither in advance, because still it is a deposit, full amount has been deposited, and they don't have any right, still it is not allotted.
So it's a refundable deposit?
If it is gets transferred.
Yeah. So unless that allotment happens,
Yeah.
it still remains as a deposit only.
So it does not qualify under investment property in that case.
Unless the allotment happens, it does not. Once the allotment happens, if we are not using that land for business purpose, then it gets classified as investment property. If we are using it for construction, for providing services or anything, then it does not.
It will go to PP.
Yeah.
In case, let's say for example, there's a property which is rented out on Airbnb or some other website. In that case, if we are supposed to revalue the investment property, then how would we go about doing the fair value structure of this investment?
So you own that property which has been rented out as Airbnb, right? So fair valuation, so again an independent valuer needs to be taken, who will do the fair value of that property basis the area rates and everything. So that report needs to be taken again from the independent valuer.
That would be quite odd.
So, you mean to say that investment property, if it is valued at, irrespective of whether it is valued at fair value or at cost, the disclosure is required as per the independent
It
value
can be
body.
carried at only cost. Index does not give you an option to carry it at fair value. It has to be carried at cost, but fair value has to be disclosed. Only for disclosure purpose you will have to get a fair valuation. Now, assets held for disposal. Now, these can be any particular PPE, land, or a disposal group as well, right? Where a group of assets has been decided to be sold off or disposed. Accounting, we all know this has to be carried at cost of fair value, whichever is less, right? From presentation perspective, these have to be disclosed separately on the face of the financial statements. They should not be clubbed along with your PPE, along with any financial asset or anything. A separate line item should come as assets held for sale. Then as part of the disclosure, you have to tell whether these are being carried at cost or fair value. Second, you have to tell that what was the reason why these assets were classified as held for sale. Right? Whether there was a change in business model, whether there is scrap of certain assets or any other reason that is applicable. Now there is also an event arises where, let's say, you have classified anything as held for sale, but the sale does not happen within the next 1 year. Ideally, these assets are classified and it is expected that the sale will happen in the next year. But let's say that does not happen. So what are the repercussions of that? Do you have to take it back, or you can still show it as asset held for sale?
Continue as accepted.
Continue as held for sale, but in that case there are certain additional disclosures that we will have to give. Firstly, we will have to explain that why the sale has not happened within that year. Second, why do management believe that they should still be continued as held for sale? Are there any firm commitments that the company has entered into? Are there any contracts that the company has entered into? What are the business plans? What are the steps that the company is taking in order to ensure that these are sold in the next 1 year? Or are there any events or circumstances that were there at the previous year and have they changed? Let's say the market has changed, there's recession or anything because of which the sale is not happening. So such kind of factors need to be disclosed in order to continue to show them as held for sale.
Now, just one step behind, if management has identified an asset, a significant asset for replacement, and that old asset they have not made any decision whether to sell or to reuse in a way to do that further developments and do it. In that scenario, will that be still a PPE and claim the depreciation?
So you are saying that they have not entered into any contract for sale,
Correct.
but the intention is there to sell.
No
They have to
intention,
make
they
the
were
intention.
thinking,
Sorry?
they were thinking which is beneficial, which could be the
The
beneficial.
So in
intention is
that
not
case,
yet
it should
crystallized.
not be reclassified. Unless and until there is a strong intention supported by any board approval, any sort of business plan, unless that is there, some sort of documentation, I don't think it should not be reclassified.
So it will be part of PPE and depreciation continues.
Correct. Next topic is on taxes. Now, deferred tax computation under IGAAP, we all followed a P&L approach, right? Which has now changed to a balance sheet approach under Ind AS. So what we need to do under Ind AS is that we need to create a tax balance sheet, compare that with the accounting base, and then provide deferred tax asset or liability wherever applicable. So this approach is very important because, see, generally what you will see in 9 out of 10 cases that even if you follow the P&L approach or balance sheet approach, you will arrive at the same result, right? But in some circumstances, let's say where there is a revaluation reserve or there is an equity component created, so in those kind of circumstances, there can be a difference in the value as per balance sheet approach and the P&L approach. So we should just keep in mind that always follow the balance sheet approach so that these things are not missed. Then another interesting thing, I think this was there under IGAAP as well, that we show advance taxes and there is provision for taxes. So generally what we do is net off these things and present as one line item, whether under asset or liability, right? And the same thing we used to do for deferred tax asset and deferred tax liability also. So I think it's just, we should keep in mind what are the factors which should be tested in order to offset anything. So Ind AS 12 has specifically provided for that guidance, that if the entity has a legally enforceable right to set off these amounts and intends either to settle on a net basis or realize the asset and settle the liability simultaneously. So generally when the income taxes or deferred taxes, these are created under the same law, either the income tax under the Indian income tax law, so then there is an enforceable right to set these off against each other. But if it's a consolidated financial statement where you have foreign subsidiaries, people have created tax assets under different jurisdictions, then we need to be very careful that all of the things that we are combining should not be netted off against each other, because then those assets and liabilities are coming from different jurisdictions and you cannot settle them on the same day, on a net basis. Another thing on deferred tax assets, so generally where companies are incurring losses, we see that either they don't create deferred tax asset, right? Or if a deferred tax asset is created, there is generally a statement which is given that deferred tax assets have been recognized on unused tax losses to the extent that entity has sufficient taxable temporary difference or there is convincing evidence that sufficient taxable profit will be available in future. So that is the general statement that companies provide when they are creating deferred tax on unused tax losses. So here one thing that is missing is when we are saying that there is other convincing evidence, we have to tell what is that convincing evidence. Okay? We have to showcase what are the evidences on the basis of which we are saying that there would be sufficient taxable profit in future against which these can be set off.
So in ICAP, I think it was more stringent.
Yeah.
This is little liberal.
Correct. But I have not seen a change in any of the companies on conversion to Ind AS where they would have changed their policy of deferred tax. I think it is more on prudence that whatever companies were following under ICAP, they are still doing under Ind AS as well.
But what could be the convincing evidence? There won't be any contracts for a manufacturer. It is more of a projections they can.
Convincing evidence is not required. No? In days supported by convincing evidence. It was ICAP
ICAP
required.
it was supported by convincing evidence, but as I said that still we are following that practice of providing convincing evidence to the auditor. I don't think so the auditors will say that okay now you can.
No, typically we would say all the years you have made profit. This was an exceptional year because of
Yeah,
something
exactly.
you made losses. That is explainable, and you see that okay going forward the company will make profit, or in past it has never. Then to, from the company side, if I have to argue, I'll always argue I will recognize that deferred tax asset.
Yeah. No, I think that that's fair. So if that is a situation that you say that where it was just a one-off year or there were certain exceptional items because of which the losses come, I think that should be convincing evidence enough. But yeah, there should be some explanation of what that evidence is.
When you say startup company which is just 3-4 years old, is quite usual to make losses.
Yeah.
What would be the convincing evidence in those circumstances?
So I don't think so they should be recognizing deferred tax assets in the initial years. Because there would not be any convincing evidence
The
in that
banker has
case.
given loan for repayment period of 10 years. Banker has believed
That's fine.
that
Banker
they
has
will
believed
create
that there
enough
is
cash
a
flows.
banker has believed that there is a going concern. The company will be there for the next 10 years. The company would have cash flows to repay that loan. But the banker has not assured that there will be profits in the company.
Taxable profits.
Taxable profits, yeah.
Can I recognize deferred tax assets up to the deferred tax liabilities available deferred tax?
Yeah, that is there. So if you read this, generally we say that only to the extent that the entity has sufficient taxable temporary differences or there is convincing other evidence. So to the extent you have deferred tax liabilities, obviously you don't need to provide any evidence to that. But in excess of that, if you are recognizing deferred tax assets when there are unused tax losses, then in that case, that other evidence should be provided.
So it will not happen that you provide for liability. Say the company has losses. You know that deferred tax liability can be provided. You will not provide for liability ignoring the asset side. You can set it off nothing. So as a result, zero will be there.
Correct. Practically, yes. I think we've come to the end of the time. There's still some topics left, but I think it will take, we can break here. Any questions on whatever topics that we have covered till now?
So what are the topics left right now?
The topics that are left are more on disclosures now,
Okay.
like share capital, related party disclosures, consolidation, certain accounting policies on consolidation, those kind of stuff.
Related party.
Related party.
Related party you can take up.
Okay. So related party, I think the normal disclosures that we provide for related party, first of all we have to provide a relationship, who is the holding company, what are the subsidiary companies, associate companies, then any entities over which we have significant influence, any entities where the KMPs have significant influence, and also who are the KMPs. So all those disclosures first need to be provided. Then specifically on KMPs, if we see a lot of financial statements are not providing these disclosures, where you have to disclose that first of all who all are included in the KMPs. Now one interesting thing that we have seen is that people have included non-executive directors but not executive directors. So the standard does not make any such difference. All executive, non-executive directors are considered as KMPs, so they need to be disclosed. And again, once we have disclosed that who are the KMPs, we also need to disclose the employee benefits that have been provided to them. So any type of short-term employee benefits, any defined benefit obligation, any ESOPs, any termination benefits, any kind of payments that are being made to them in their capacity of being an employee, those also need to be disclosed.
In subsidiaries, some people are identified as KMPs. While preparing the console, do I need to carry all these subsidiary KMPs in the console accounts, or I need to consider KMPs of the holding company in the console accounts?
Holding company only. Because the signing, if you see, will be done by the holding company itself. So this KMPs will come of the parent company itself.
That is the logic, or it is written in the standard as such?
No, the standard also mentions that.
That only holding company we need to disclose. Even if it is a material subsidiary, say holding company is immaterial and the subsidiary is material. It can happen. If you see a holding company is just an investment company,
Yeah.
but the subsidiary company is the real business that is lying. So in that scenario, you are saying that whatever KMPs in the holding company is that only needs to be disclosed, nothing should come out.
Because, see, I get your point, and on the basis of materiality, we can make that judgment, but I think as per the guidance, it is that the parent company has to disclose the KMPs. Any other topic that you would like me to cover?
On the arm's length pricing on related parties, can you throw some light on how the disclosure happens?
See, there is no specific disclosure that we need to provide as part of related party disclosures on the arm's length pricing. But if there are any transactions like we discussed, loan to subsidiaries, financial guarantee contracts, which are not at arm's length, then when we are accounting for those or when we are giving the accounting policy for those, that needs to come there. That if these are interest-free loans, then the other component is accounted as an equity contribution, or if as an investment in subsidiary. But there is no disclosure as such in the related party schedule that you need to give.
Most of the bigger companies, I see that disclosure, the transactions with related parties are at arm's length.
No, that is as part of the accounting policy again. That they give that as a policy, all the transactions with related parties are at arm's length. So therefore, there is no question of that equity contribution and all those things.
So what is the auditor's role in ensuring the transaction is whether at arm's length or not?
So, generally, what happens is that.
Auditing. So auditor's role is basically, if you comment in CARO, there is section 188,
Yeah.
which talks about arm's length reporting, whether the transactions are at arm's length. So there you need to first of all assess. There is one reporting is cast over there. Secondly, if you see whatever NAFRA has picked up, the recent reports of all the companies that they have kind of reviewed, they have come out heavily that auditors have not assessed on arm's length. Now, how to assess the arm's length? You have to see whether the transaction which you have done with an unrelated party, whether the same terms and conditions, whether the same price was used.
That becomes a whole process again. I mean, like,
Yes, this is the process.
Because all the board resolutions will state that the transactions are at arm's length.
But how that is
Responsibility
concluded?
is of the company.
How board has
Primary responsibility is of the company. As per the Companies Act also, you are supposed to maintain all the transaction at arm's length. If there is any interested director also, that would be anyways disclosed in the board report. So it is at the company's management assessment that it is at the arm's length. So it's not auditor's responsibility to find whether, but adequate documentation, whether it was at arm's length. For example, a transaction is there, whether the board has taken the comparative quotation with unrelated, we don't have to do that exercise. The board should have demonstrated it. So it's not auditor's responsibility to do that.
So auditor can actually rely on the board's resolution where it states that the transactions are at arm's length.
Just to demonstrate that, when you look at the IFC and all, whether this is happening, whether the board has demonstrated it, when there is a such transaction, whether there are comparative quotations taken already by the company, whether it's arm's length is what we have to look into that. Because they signed that, saying that this is that. If they have signed, they would have done it on a demonstration. Right? They wouldn't have signed it blindly saying that of course it's at arm's length. So even that has to be fine.
consolidation, if you can take that.
So consolidation, I think I had a couple of things that. First of all, it was on the accounting policies. So, as per the standard, it says that if there are different countries, so the standard says if the group consists of various subsidiaries, then we need to look at their accounting policies to ensure that the accounting policies for similar transactions are similar in nature. Now, in a group where different countries are domiciled in different countries and they are following different jurisdictions, it becomes very important at the time of consolidation to see whether the accounting policies are aligned or not. So, now let's say, for example, we talk about financial assets, right? So if there is an Indian entity or IGAAP entity that might not be discounting financial assets, but it has a subsidiary which is outside India following IFRS, which is doing that discounting. So then the subsidiary's accounting policy need to be aligned as per the parent company's accounting policy. So all those adjustments need to be reversed, they need to be brought back to IGAAP in order for us to do the consolidation. So that's one thing that needs to be kept in mind. Second interesting thing which I came across was that companies are giving a line item as intra-group adjustment in their consolidated financial statements. So ideally, that intra-group adjustment is basically when you are not able to eliminate your intercompany transactions, right? Otherwise, that intra-group adjustment should be zero. So yeah, that's something that even if it is a non-material number, it should not be there, right? As part of your asset liability or wherever, that intra-group adjustment is like not acceptable in the financial statements. So again, that is something that we should be aware of. Also, when we are doing the intra-group eliminations, if there is an element of profit or loss in that elimination, we should be mindful that the impact of deferred tax should be taken into account while doing the elimination. A lot of places we are doing just the elimination from profit loss or asset liability, but we are not adjusting the deferred tax impact on that intra-group profit or loss. So that also needs to be kept in mind. One other thing on segment reporting. Now, generally when we see that segment reporting is given in IGAAP, we used to give by business segments and geographical segments, right? Under Ind AS, it says that you have to analyze that what are the primary segments of the entity on the basis of which the chief decision maker is making the decisions for the entity. So basically how you are doing your internal MIS, on what basis you are doing your internal MIS, taking internal decisions, on that basis only you should give your segment reporting also in the financial statements. And when we are giving segment reporting, we'll give revenue, we'll give cost of sales, all those things, we'll give a reconciliation to the profit amount also. But another thing which is missed, another thing which is missed in this is the entity-wide disclosures. So even if we have given all the segment related disclosures, or if we have said that there is just one segment and we don't need to give any disclosures, these entity-wide disclosures still need to be provided. What are these? First is information about products and services. What are the different products and services of the company? What are the geographical areas in which it operates and the revenue and assets bifurcated between those geographies? And information about major customers. Are there any significant customers? Is there a concentration risk that the company has, that 90% of the revenue is being generated from 10 customers only? So such kind of disclosures need to be given. Okay, I would conclude my presentation here. Thank you everyone for your attention.
Can you give company names where we can in a public domain refer for a good disclosures all that?
So generally these companies that come up like Infosys, TCS, all these companies have good level of disclosures. Apart from that, we can also refer the model financial statements. So a lot of model financial statements are released by Big Four, GT, all these. So there you can have like a comprehensive view of every disclosure and every standard.
Thank you, Pranjali. One of the important aspects, and when we keeping the audit in mind, and these are all very minute things but very important and critical, and which could cost us. I mean, if you see the latest ROC scrutiny letters which are coming in, these are the points which are coming up in the ROC's observations, and ROC is asking the auditors questions on this, saying why have you not looked into this disclosure, or why is this left out. So very important, and you took this session elaborately and giving the time for everybody to interact. So thank you so much. On behalf of Bengaluru branch, we thank you wholeheartedly for this session. Thank you so much. I request Chairman to hand over the memento to the speaker.